Okay, ladies and gentlemen, welcome to this FSDC webinar for launching the paper on enhancing market liquidity and efficiency, optimizing stock trading mechanism and operations in Hong Kong. This is the second paper focusing on market liquidity enhancement that FSDC has released within the space of 10 months. In light of rising market competition and dynamic shifts in international regulatory environments, we believe Hong Kong needs to adopt a pragmatic approach towards modernizing its financial market operations and upgrading the stamp duty legislation. Our paper is putting forward recommendations that aims to enhance Hong Kong's status as a world-leading IFC without significantly impacting stamp duty revenue. On this note, I'm delighted to have our working group leader, Rex Ho at PwC, together with two of our working group members, Mr. Darren Bowdern from KPMG and Ms. Ping Fan of CITICS CLSA as our panelists. Before I invite Rex to give a brief highlight of the paper's recommendations, I would like to thank all the working group members for their valuable contribution to this insightful paper. Over to you, Rex.
Thank you, Kate. Good morning, ladies and gentlemen. I'm actually very glad to have the opportunity to present this paper to you today. As King mentioned, in August last year, FSDC issued another paper entitled Boosting Market Liquidity and Diversity, Enhancing Hong Kong's Competitiveness as an International Capital Formation Center, to look at several factors with a view to boosting market liquidity and diversity. One of the areas that the last year paper has touched on is Hong Kong's stamp duty on stock market. Also, the government has earlier set up a task force to study measures to boost the liquidity of the Hong Kong stock market. One of the outcomes of this study is to reduce the stamp duty rate from 0.13% to 0.1%. Now, this paper is a follow-on study to specifically look at how Hong Kong stamp duty affects certain type of stock transaction and capital market operation in Hong Kong, and make specific recommendation on some area with a view to increasing the market efficiency and ensuring the Hong Kong stamp duty regime on stock transaction remains fit for purpose in the context of modern capital market operation and modern financial products. To set the scene for our discussion, let's look at some background information about Hong Kong stamp duty. Hong Kong stamp duty is generally imposed on Hong Kong stock transaction and Hong Kong landed property transaction. For the purposes of this paper, we only focus on the Hong Kong stamp duty on stock transactions. Now, when a buyer or a seller to execute Hong Kong stock transaction on the Hong Kong Stock Exchange, currently each side has to pay 0.1% of stamp duty, together with other trading fees and every, including the exchange fee, also the SFC transaction fees. But one thing is worth noting. Hong Kong stamp duty accounts for more than 90% of the total transaction cost when you execute a Hong Kong stock transactions. If you look at internationally, how's the other international stock market, whether they charge similar stamp duty. In fact, some stock markets still charge stamp duty. But if you look at the major international financial center, US, Japan, they don't charge stamp duty. Basically, there are only two international financial centers still right now actually charge stamp duty, which is UK and Hong Kong. For UK, in fact, it's also different from Hong Kong because UK has a specific exemption regime for market intermediaries, which Hong Kong doesn't have. We will have to cover that point later on. Now, while there has been a lot of debate as to whether Hong Kong stamp duty should be completely abolished in order to help to boost the market liquidity, we recognize that Hong Kong stamp duty on stock transaction is also one of the very key revenue source of the Hong Kong government. So the focus of this paper is not to look at whether stamp duty should be abolished. Rather, our focus is to look at the areas where the existing stamp duty regime can be modernized and improved to make it fit for purpose in the modern capital market. As King mentioned, the revenue impact of our recommendation should be minimal. We have to look at 5 areas where the existing stamp duty rules and regulations have created inefficiency for the stock market. These 5 areas include stock borrowing and lending transactions, using Hong Kong stock as collateral, market intermediaries carrying out market facilitation activities, dropping business exemption, which is market making exemption, and finally, stamp duty payment mechanism for institutional market players on off-exchange transactions. Let me go through these recommendations one by one. The first one is the stock borrowing transaction. They are, in fact, very important transactions to facilitate investors to carry out different strategy. For example, short sell and also other hedging transactions in the capital market. Currently, stock borrowing transactions are exempt from stamp duty, provided that they are genuine stock loan transactions, rather than disguised buy-sell. However, to qualify for the exemption, the borrower also have to fulfill a number of administrative requirements, including having a stock borrowing agreement for every single counterparty and register that agreement with the stamp office within 30 days. Failure for fulfilling this registration requirement would render the transaction, even though they are genuine stock borrowing transactions, to become dutiable, leading to stamp duty costs and the associated potential late payment penalty. As a result of the serious consequences, most market players have taken tremendous effort to comply with the registration requirement and will only carry out stock borrowing transaction when they receive positive confirmation from the stamp office. This introduces the inefficiency in the market. With a view to enhancing the efficiency of the stock loan transaction in the market, one of our recommendations is to remove the non-substantive administrative requirement, including the registration requirement. The second issue that we have looked at is the use of Hong Kong stock as collateral. Under the current stamp duty regime, the use of Hong Kong stock as collateral for a loan is exempt from stamp duty, including the initial posting of the collateral and the subsequent return. However, such exemption does not cover other modern financial transactions, for example, derivative. So therefore, if you post Hong Kong stock as collateral for a derivative, that posting of the collateral is not exempt from stamp duty. So our recommendation is to expand the exemption scope to cover the other financial transactions, as long as the Hong Kong stock are used as collateral only, such that the Hong Kong stock, the scope of usage of Hong Kong stock can be increased. The third area that we have looked at is the market facilitation activities carried out by the market intermediaries. I mentioned UK has a specific exemption regime for market intermediaries, whereby the market intermediary can be exempt from UK stamp duty when they carry out normal market facilitation activities. However, Hong Kong does not have such exemption. As a result, the market intermediary in Hong Kong, for example, the broker, when they execute certain type of the transaction in the market, they have to put in place special arrangement in order to avoid multiple layers of stamp duty imposed on one execution. Now, such arrangement increase the fractional cost of the transaction and also decrease the overall efficiency of the transaction. So therefore, our recommendation is to provide clear stamp duty exemption for the market facilitation transactions. The fourth area that we have actually looked at is the market making exemption. We call it dropping exemption. Currently, market making exemption only applies to market maker on single stock options and ETF. However, no exemption is applied for other listed derivative products like warrant and CBBCs, which have very similar characteristics as options and are widely popular. Hence, our recommendation is to create a level playing field for other listed derivative products and to provide specific exemption for the related market-making activities. Now, in fact, we have actually seen some success story in the past for introducing exemption for derivative product. The government introduced the ETF market-making exemption for stock transaction associated with in-kind allotment and redemption of ETF unit in 2020. After the introduction of the exemption, we have seen significant increase in the ETF activities in the market. So therefore, we hope the exemption extended for other derivative products can also bring the corresponding increase in the trading volume of the listed derivative products. The final recommendation is related to the stamp duty payment for off-exchange transactions by institutional investor and market participants. There are currently only very limited number of electronic stamp duty payment methods, including credit card or fast payment system, PFS. These methods, however, are not commonly viable payment methods for institutions, including especially for the large financial institutions. As a result, financial institutions still need to prepare checks and manually submit the check to the stamp office every day for the payment of stamp duty for off-exchange transactions. This creates a lot of administrative inconvenience, especially during the COVID period a couple of years ago. And in fact, this manual payment also goes against the direction of developing Hong Kong as a smart city. So therefore, we recommend that the electronic payment method to include bank transfer and or other means which can be commonly adopted by financial institutions. So is the above summarize the key point of the paper. So I pass the time back to King. Thank you.
Thank you so much, Rex, for that overview. As we know, Hong Kong is renowned as one of the world's largest capital market, an important attribute of the city as an international financial center. As I mentioned earlier, we've been focusing on liquidity enhancement policies for the past 10 months or so. So as the working group leader of this second paper, please share with us the importance of market liquidity to Hong Kong as an IFC.
Okay, thank you, King. I think market liquidity is the cornerstone of a robust capital market. We all know in the past 2 years, Hong Kong has been facing a lot of the headwinds, in particular the geopolitical tension, in fact, which actually led to some moderate decline of the performance of the Hong Kong capital market. But having said that, the Hong Kong exchange is still remain as the top 10 global exchange and also top 5 in Asia. Now, this success basically can be attributed to the depth of the breadth of our capital market, which allow the robust trading activities to happen, and also there are a lot of a wide range of products offered in the market. Now, I think the current position of the market, of the Hong Kong Stock Exchange market, to a large extent is because we can maintain the market liquidity. As I mentioned, market liquidity is the cornerstone for efficient operation of the capital market. It can allow the execution of large transaction, large order with minimal price distortion. A deep pool of liquidity is also very important to attract domestic and international investors. The liquidity actually, if you have good liquidity, it also has to reduce the trading risk in the market. So I think this is very important to entice participation of overseas investors to trade on our market. It also has to follow, given people actually start can be attracted to trade on the market. It also not only attracting investor, it also attract issuer to issue equity and also even actually debt instrument in our market. So I think this is the very clear, very important, very fundamental to the Hong Kong stock market to maintain the market liquidity. Now, apart from the investor side, the market liquidity also can actually drive the transaction cost down. It can actually allow sufficient demand and supply of the trade support activities and also the associated activities. It also actually can reduce the cost of company coming to Hong Kong, raising capital, and also the transaction cost of stock trading. Okay, so therefore, this is beneficial. It's actually not only to the listed company, but also to the investor. Also, I think the liquidity can also can facilitate the growth of the other derivative product. It can enrich our product suite in the market. So therefore, the working group consider this actually very important to take steps to continue to actually boost the market liquidity, making the market more efficient.
Thank you. Yeah, as you said, right, liquidity helps price discovery. So to set the scene for our discussion, I want to turn to our tax expert who made a lot of valuable contribution to this paper. That's Darren. Could you please give us a brief overview of the stock trading mechanism and stamp duty regime in Hong Kong? How do these mechanisms and regulations compare to those in other jurisdictions?
Thanks, King, and thanks again, Rex, for the overview and the summary of our findings in the report. Rex was talking just then about the importance of liquidity and really the status of Hong Kong as certainly one of Asia's leading capital markets. And as Rex has already highlighted, stamp duty is a significant component of the cost of doing a trade in Hong Kong. Stamp duty is a transaction tax. We are still only one of the very few global markets that does impose stamp duty on a share transfer. But it is a significant component of the revenue here in Hong Kong. Now, as many people will be aware, and as Rex has already highlighted, stamp duty is a charge on the transfer of stock on the exchange. It's imposed on the buyer and seller. And for a borrowing or lending transaction involving Hong Kong stock, it could be a significant cost component for doing a trade if the requirements of the stock borrowing and lending exemption are not satisfied. Now, as again, people will be aware, we do have a favourable stock borrowing and lending exemption regime, but it does involve satisfying a number of conditions, including, as Rex was highlighting before, some what we refer to as non-substantive administration conditions, which do place a burden on the compliance aspects. So in the absence of the exemption applying, if you were to borrow Hong Kong stock, then stamp duty would be payable on the borrowing and the lending. So effectively, it could result in 40 basis points of stamp duty being paid. Now, in order to qualify for the exemption for a borrowing and lending transaction, you need to satisfy three broad conditions, and Rex has sort of touched on those. The first condition involves the use of the stock being for what we refer to as a specified purpose, and that's pretty broad, and it does include settling a sale of Hong Kong stock. It includes the potential future sale of the Hong Kong stock or the replacement of already borrowed stock, or even on lending that stock for under another borrowing and lending agreement. And it can also include any other purpose that is authorised in writing by the collector. But it's really the administration side of the stock borrowing and lending which we feel strongly that should be reformed and updated, because Rex was talking about the registration requirements for a stock borrowing and lending agreement, which must be made by the borrower within 30 days. And if you have multiple borrowers involved, then each borrower has to register that separately. Then the borrower needs to keep a stock borrowing and ledger to record the transactions. And then you need to file biannual stock returns. And then ultimately, the last condition that you need to satisfy is that the borrower needs to return the stock or an equivalent payment. And during the holding period, that any dividends or interest that may be received on the borrowed stock needs to be returned back to the borrower. Now, the issue that Rex again highlighted is that if you don't satisfy these conditions, especially around the registration, and if you fail to meet those registration requirements, then the borrowing and lending exemption doesn't apply and stamp duty would be chargeable on that. So how does this compare to other jurisdictions? Well, we've already touched on the fact that most major markets don't impose stamp duty anymore, so it's not really an issue. Even in Singapore, there is an effective exemption for scripless transactions as well. So it does, from a Hong Kong perspective, and from a market liquidity perspective, it does impose a burden on those market participants in satisfying these exemption conditions. There are some other issues which Rex was highlighting before as well, regarding the impact on financial intermediaries as well and their capacity, whether they're acting as a principal and agent. And again, we're asking for some reforms around that. King?
Thanks, Darren, for explaining these the key issues for us. So I want to turn to Pen, as a practitioner in the market. So what do you see as the main attributes that international investors will look for from a market like Hong Kong as a capital and investment hub? So what specific strengths does Hong Kong possess that make it an attractive destination for destination for investment?
Thanks. I would say probably there are a lot of attributes that the international investors are looking for in a particular market. Probably I'll just name a few. So number one, like free capital flow. So the cash in and out of the market should be freely, can be done freely. And something else like a lower investment cost. Rex mentioned about the lower exchange fees. And certain jurisdictions actually provide capital gain tax exemptions. Hong Kong doesn't also have the same incentive. And also like, transaction tax or stamp duty, which can be exempted or can be waived. That actually is also a reduction of cost from an international investor's perspective. And other attributes like the variety of the products that exchange can, a particular market can offer. And the large market capitalization, because that sort of ties into what Rex is saying, the liquidity. If the market capital base is large, and normally that means the liquidity is also very fast, and that actually ties into a lot of things. I won't elaborate, too much because I think Rex has already touched on those points. And some other attributes the investors are looking for, like the certainties on regulations and rules, especially if those regulations and rules are more in line with international standard, in line with the international norms. It's easier for international investors to comprehend and also easier for people to follow because it's clear. They know what to do. Other things like the market, from a market perspective, the trading system stability, that's important. Unlike like a few, I think everybody heard the news, the New York Stock Exchange has a system the system was down. Yeah, because of the system was not very stable, that caused a lot of issues, and some actually shares got impacted as well. Including Warren Buffett's shares, right? And also some other things like the risk control need to be clearly structured. If there's any, and also any market, even though the market could be large, but it's important for the market to be nimble in terms of adapting to the change or the never-ending dynamics of the international practice or international norms. So having said that, I guess to answer your second question, to address your second question, King, regarding what Hong Kong market possess, I would say, to be honest, in my personal view, Hong Kong markets actually possess all of those attributes I mentioned earlier. Of course, there are always room for improvement and enhancements because our competitors are always improving themselves as well. We don't want to be left behind. And I'll give a couple examples. For example, the past 2 or 3 years, Hong Kong Stock Exchange actually introduced this new Chapter 18A and 18C, which actually encouraged the international companies, technology companies listing in Hong Kong. it proved to be very successful. Last week on June 13th, there was a new IPO, which actually was issued in Hong Kong, which is issued under Chapter 18C. And it's actually oversubscribed by over 100 times of the original offer, the notional offer. And also another thing I want to mention about Hong Kong market is its unique position in terms of serving as a channel for the international investors who are interested in investing in China. There are many channels right now offered by Hong Kong market that the Stock Connect, Shanghai Stock Connect, Shenzhen Stock Connect, Bond Connect, and also recently, it was last year, actually, Hong Kong also offered this Hong Kong dollar RMB dual counter model for trading of the China shares. And also one other new thing introduced is the Wealth Management Connect. So all this, just name a few, right? I'm sure there will be more coming. Essentially, Hong Kong is in this unique position of offering a lot of channels. So Hong Kong is not alone. Hong Kong is actually offering the Hong Kong market as well as the mainland China market to a lot of the international investors who are interested in. So from a regulatory perspective, when I touch upon the always room for improvements, right? From a regulatory perspective, given that today's topic is on the stamp duty, we definitely are looking forward to any modernization of the stamp duty ordinance. I think this would definitely play a key role in terms of continuing the opening up of the Hong Kong market to the global investors.
Thank you for highlighting the strength of Hong Kong financial market, especially the stability of our infrastructure. But on that note, I want to look at what challenges there are in stock trading mechanisms, because efficiency is important. So, Rex, when the topic of stamp duty arises, it is common for the public to immediately associate it with discussions of reducing or entirely eliminating even stamp duty on stock trading. However, our paper approaches this issue from a very different angle. Rather than focusing solely on the stamp duty rate, the FSDC considers the administrative burden associated with stamp duty to be of greater concern. So could you please elaborate on why proposing a reduction in stamp duty may not necessarily be the most effective solution?
Okay, thank you, Kim. I think that question of whether the reduction or abolishment of stamp duty can increase the market liquidity, I think this debate has been in the market for many, many years. I think that diverse view. Some people will say Hong Kong stamp duty affect the development of some of the product. For example, high frequency trading. Okay, because of Hong Kong's stamp duty is actually very difficult to do high frequency trading. It's actually very costly to do it as compared with the other market in US, in Japan, or in other market without stamp duty. Then the high frequency trading activities will be actually much bigger. Of course, there are also other views as to saying that stamp duty is only a cost when you actually do buy, when you do sell, and this is not a key consideration for the investor to decide whether to buy or sell. The key of the consideration should be whether that trade can actually make money. Okay, so there are always different views on this topic, and it seems like there's actually no consensus in the market. Especially in view of the fact that stamp duty, in fact, actually is a very efficient tax type for the Hong Kong government, and it contributes a lot of the Hong Kong revenue. So if we take away the Hong Kong stamp duty, say what to actually fill that hole, that's another question that we need to consider, right? But so putting aside his controversial subject, the working people actually feel, in fact, even though the stamp duty rate is not reduced, there's still a lot to do in order to make the stamp duty rules on stock transaction more fit for purpose. Okay, why I say fit for purpose is Hong Kong stamp duty, in fact, is a very old rules. It's a very old law, old piece of legislation. Over the last 20 years, on the stock transaction part, there is no holistic review or update on the provision. So paying mention about the market development, in terms of the market infrastructure, in terms of the new financial product introduced, different type of derivative. The working group basically feel the current stamp duty law cannot keep pace with the development of the market. So therefore, the area that we have to focus on this paper is, first of all, is to eliminate those areas, the outdated Hong Kong stamp duty rules, increase the inefficiency in the market. We actually need to eliminate that inefficiency caused by the outdated rules. So therefore, this is the focus of our paper. Now, when you have to look at the 5 areas that we suggest, we also look at it from this angle. So some are the rules which has been made before the product exists, the current product exists. So therefore, those areas have to be updated. For example, warrant, CBBC, the exemption, basically when this introduced option, back in the option market maker exemption back in 1990s, warrant and CBBC basically still haven't exist. Okay, so I think it's the time to review the application or applicability of the law to the modern financial product. And also on some of the area like stock loan transactions, Darren mentioned about there should be better monitoring system which can relieve the market in the market player to put in a lot of administrative effort to fulfill certain administrative requirements. Right now we talk about smart city. Then we have to actually do it in the digital way, in a more smarter way. So therefore, the 5 recommendations is actually basically what we are trying to do is to, with a view not to reduce the revenue, whether these are the areas that we think can make the market more efficient and indirectly can increase the market volatility.
Thank you. Right, yes. For highlighting those important recommendations. And by the way, I hope it will be implemented as quickly as our recommendation of 18C, because it took Hong Kong Stock Exchange 12 months to implement our recommendation. So now we talked about market moving ahead of regulation. So maybe I want to turn to Peng again. Understanding in today's financial landscape, securities trading activities are conducted in many ways, informs to fulfill clients' diverse needs, to navigate the complexities of executing large order trades and significant transactions. Financial institutions employ agile solutions to mitigate market volatility. So what do you see as major challenges facing financial institutions in performing their intermediary facilitation roles?
Thank you. I would say, generally speaking, I think the major thing we want to highlight today is the FIs and also international investors see it as being the challenge in terms of executing facilitation trade is the uncertainties of how the stamp duty rule should apply in this kind of transactions. Everybody mentioned earlier that basically the stamp duty ordinance has been drafted many years ago. I think the first introduction was in 1981, so quite old. The way it's being drafted, the wording basically essentially just describe a very basic scenario where the clients place an order with the broker or the agent, and agent executes the trade to the market, and it's done. However, in the scenario, especially in the modern world, their clients has grown more sophisticated. They actually, their needs are more sophisticated and more complex. When we say the clients, we're referring to the large clients like hedge funds, mutual funds, pension funds, sovereign fund. They have a large capital base, so their investment strategies are complex. Their demand on the execution is also very complex. As a broker, as an FI, how to execute those trades smartly so that we can both fulfill the client's need, as well as we want to make sure it doesn't have whatever the large order, the large execution will not cause a negative impact to the pricing in the market. That itself is a challenge. It's something financial institution has been implemented a lot of the execution mechanism to ensure we actually fulfill both ends of the needs. In Europe, under the MiFID rule, there is this concept called risk-less principle. Essentially, that concept or that terminology fits in squarely to those kind of brokers who are acting as an intermediary in terms of executing those facilitation trades. So when you think about financial institutions, basically we have two roles. One is to, we serve the clients and make sure, their orders are being fulfilled. And secondly, we need to safeguard the market performance. And so that's why we're really looking for, if Hong Kong consider introducing this or grant this exemption to the intermediaries, it actually will help not only from the international investors' perspective, but also from a financial institution perspective, so that to help to boost up the trading of the Hong Kong market with certainties.
And maybe, Ping, just to add one comment to that, which is what we touched on just very briefly before. Sometimes it's not very clear whether or not the trade is being executed as a principal trade or as an agency trade for the reasons that you've just mentioned. And of course, stamp duty would apply in the absence of an exemption, of course, if it was a principal trade, even though in substance you're acting as an agent for the counterpart for your clients. And that's why it's important to get some updated rules similar to other jurisdictions for financial intermediaries. So when they are actually acting essentially on behalf of their client, whether it's a principal or an agency trade, there should be an exemption for that, which is what we're looking for.
Yeah, thanks, Ping and Darren, on that important point. In fact, I want to follow up with you, Darren, on that. The stock borrowing and lending facilitates a wide range of market transactions and is an important support for market liquidity. So based on your extensive experience and interactions with industry stakeholders, could you share your insight on the challenges that industry faces in terms of complying with the requirements of stamp duty exemption for stock lending, stock borrowing and lending trade transactions? So how does Hong Kong compare to other jurisdictions in this regard?
Yeah, well, thanks again. Really, it's around the administration of the borrowing and lending exemption rules, which cause the most problems, the practical problems, that is, because there are very strict administration requirements in order to qualify for the borrowing and lending exemption. As we've already touched on, the SBL agreement needs to be registered within a certain period of time, within 30 days of effecting. And if there are any amendments to that agreement, then those changes, whether the agreement is novated or there's other changes made to the agreement, then those changes then need to be re-registered again. And it's really the compliance around these aspects that some front office personnel just aren't aware of requirements, which causes problems. And the point that I think Rex was really emphasising, and which we emphasise in the report, the fact that you may not strictly comply with the registration requirements, but otherwise it is a proper stock borrowing and lending agreement, you shouldn't be penalised because of that. Because the potential outcome for non-compliance is not only is the stamp duty payable, but there are potentially penalties that apply for non-compliance. And those penalties on paper can be quite harsh. They're up to 10 times the amount of the duty. And so we have seen, and all of us, all the Big Four have seen cases where upon doing a review of the stock borrowing and lending requirements, you may have some agreements which haven't been properly registered. And then even under a voluntary disclosure, you can have quite harsh penalties and back charges for stamp duty. So again, the report, I think it's very clear that it's almost, there should be a self-review basis. There shouldn't be a need for a formal registration of a borrowing and lending agreement. The report feels very strongly that we should have a self-assessment, which is a self-assessment basis for stock borrowing and lending agreements, which are, by the way, very standard agreements these days. And then there's do away with the requirement to register those agreements. And a self-assessment system would be very much sort of in line with some other incentive regimes that we do have here in Hong Kong, where you don't have a separate registration process for that. Because ultimately, if you don't comply, the penalties can be harsh. And we have seen, I'm sure Rex has seen it at his firm, we have at our firm, some very harsh penalties for back stamp duty charges, which runs in the tens of millions of dollars.
Yeah, correct. I also want to actually supplement. I think the whole working group or the industry actually feel is, like we all know this is the legislative intent to exempt genuine stock loan transaction. So the focus is to actually look at whether the transaction is a genuine transaction, rather than putting the focus on whether the agreement is registered or cut. And then as Darren talked about, is the consequences for missing all this administrative step is serious. Okay, we also have to feel, the industry also have to feel, is not in proportion with the non-compliance. The non-compliance is just a miss administrative step, but it can actually render everything become dutiable and then plus penalty. So this is also one of our recommendation of the working group is remove or simplify the registration process, plus also have to review the penalty level for missing the administrative step. It should not be actually applied to whether the transaction should be dutiable or not, because this is a genuine transaction, then it should be exempt. Then you can actually put for example, a lump sum penalty for missing the administrative step, rather than actually rendering all the transactions become law and qualified. So this is also one of the recommendations made by the working group.
Yeah, it's a very good point, Rex. I mean, the potential penalties are so harsh that they're just not commensurate with the sort of misdemeanor. And that sort of also goes with the other point that we're touching on, that Ping mentioned as well, around financial intermediaries as well. You know, if you are executing trades, you could be seen to be doing it in a principal capacity, and therefore stamp duty can potentially be payable, whereas really you're acting for a client and you're really acting in an agency capacity.
Yeah, absolutely. Darren and Rex, for highlighting that, the importance of upgrading a regulation to move with the time, and some of these penalties, as you said, is really very outdated and reasonable. So, moving on to a next topic that I want to discuss with the panel, that's how we can optimize our stock trading mechanism. So, on that, I would like to turn to Ping. So, given the widespread use of Hong Kong stocks as collateral for various financial transactions, the limited scope of the existing stamp duty exemption raises concerns. So how can the stamp duty framework be adjusted to accommodate the evolving financial landscapes and reduce transactional costs for market participants utilizing Hong Kong stocks for collateral in sophisticated financial operations?
Thanks, Kim. Actually, the short answer is actually it's quite easy to make the adjustments. Because again, drive home the point about the stamp duty ordinance have been just definitely need to be modernized. As I mentioned earlier, it was first introduced back in 1981, and now at that time, the rule essentially says it's if there's a genuine a loan. The Hong Kong shares if the Hong Kong shares are posted with collateral against those loans, there's automatic stamp duty exemptions. So very helpful, very clear guideline in that sense. However, dealing with the financial industry, evolving, now derivative transaction become very, very popular, well known. The rule didn't really touch on this point. However, in the derivative transaction, governed under the ISDA, international standard, the ISDA, there's always a clause which commonly being used by the counterparty of the derivative transaction, which is called credit support annex, or a CSA. Essentially, that CSA means there are collaterals required at the back of the derivative transaction. So for security purposes, right? So and then that collateral could be posted in the form of cash, debt instruments or shares, equity shares, or like some other things like a treasury T-bill, like government securities as well. And for the most part, the shares posted as a collateral actually is a lot cheaper than a cash collateral, especially in a very high interest rate environment, which is the environment we're living in currently. Absence of this stamp duty exemption, essentially, if somebody posts a Hong Kong shares as a collateral against those derivative transactions, that will be a dutiable event, a dutiable transaction. So no one wants to do that. So a lot of time people would rather put in cash or put in UST bill, basically to serve as a, under the CSA requirements. So what we're really looking for is if the existing, this is called section 27.5, right? Without getting too technical, essentially this automatic exemption on Hong Kong stamp duty relating to the Hong Kong shares being posted as a collateral, if that exemption rule can be expanded from not only apply to loans, but also to apply to derivative transactions, it actually will help a lot, basically serve the purpose. So that's why I'm saying is that actually it should be a quick fix and an easy fix. But that being said, and that definitely requires a change of legislation. I know I don't want to understate the fact that, it needs to go through all the legislative process to make it happen. So I would say essentially it was, a holistic review of the stamp duty ordinance certainly is helpful. But things like this, the expansion of the automatic Hong Kong stamp duty exemption on posting the Hong Kong shares, that actually can be considered the low-hanging fruit or a quick fix, right? Especially now, I understand that the Hong Kong Stock Exchange are working on establishing a automatic clearing system on the OTC derivative transactions. So actually in the scenario whereby the Hong Kong shares are posted as a collateral against those OTC transactions through a systematic way, it actually also helps to track the Hong Kong shares posted as a collateral in that sense electronically, right? It actually could happen very easily. We can actually piggyback off that whole initiative that Hong Kong Stock Exchange is initiating. So, so that's why I think this probably is a good timing that we actually in our paper, we touched upon this one, and hopefully it will actually be considered as part of the same, the trading initiative that Hong Kong Stock Exchange is taking on.
Excellent. Yeah, so it's good to know that the issue is being addressed collectively. There's another issue I want to bring up with Rex. That's the current drop-in business concession has played a pivotal role in stimulating the trading of listed options in Hong Kong. But why is it important to cover other listed structured products, such as listed warrants and CBBCs that you mentioned earlier? So what benefits would such proposed expansion bring to the market?
Okay, thank you, King. I think one point before we talk about the CBBC warrant, I think that one thing I want to say, draw the attention of the participants. In fact, Hong Kong has a very successful listed derivative market. In fact, the Hong Kong market, Hong Kong Exchange, has been ranking #1 globally in terms of the turnover of securitized derivative for the last 5 years. Okay, so our listed derivative market is very successful in the internationally. Okay. How to strengthen? I think the question is how to strengthen our position, reinforce our position in the listed derivative market. I think one of the area is to extend the exemption. Right now, the market making exemption, as we mentioned earlier, only applies to single stock option. We also actually give there is also a market making exemption for ETF. And also dual counter market maker, okay? But there are actually two very important products, warrant and CBBC, are missed out from that exemption. In fact, if you have to look at CBBC, warrant, in fact, they have actually very similar characteristics as options. So the working group believe there should be a level playing field amongst all these listed derivative product with similar characteristics. So that's why we actually propose to extend the exemption to CBBC and also to Warren to further enhance the trading volume of this product. I touched on it earlier for the success for introducing the ETF market making exemption back in 2020. In fact, after the introduction of that ETF market making exemption for stock transaction in relation to the in-kind allotment and the redemption of the ETF unit, we have actually, in the last 2-3 years, we have seen substantial increase in the ETF trading volume. If you look at some data, 2023, the year-on-year trading volume of ETF increased by 18.5%. So if we can give similar appropriate exemption to also actually cover Warren and CBBC, we hope that we can replicate that success story again.
Yeah, absolutely. We should really strengthen our leading position in listed derivative trading. So, Darren, I want to turn to you on another issue that the industry has been facing. You actually alluded to that earlier. The appropriate penalty for late payment and all that. So, the financial services industry faces ongoing challenges, particularly concerning the acceptance of payment methods for corporate duty payers, such as financial institutions, in light of the proposed recommendation to introduce electronic stamp duty payment for off-market and drop-in transactions. So what are some of the advantages that both market participants and the government can derive from this initiative?
Yeah, thanks. I mean, Rex mentioned before that unusually in Hong Kong, many of the market participants still need to resort to writing checks in order to settle their stamp duty payments because they just can't comply with using the credit card facilities or the FPS facilities. So really, I mean, from an industry point of view, it's really the benefits of e-payments simply just around the efficiency and the cost of doing that. Clearly, from a market participant perspective, it really streamlines and expedites the stamp duty payment process. Clearly reduces the administrative burden and requirements around facilitating a payment by way of check and sending that through. And then a e-payment system clearly is allows for an auditable, a better auditable process than a manual-based payment system. So there's greater transparency, clearly, allowing the participants to easily track the payment process and reconciliation of that as well. So overall, it's really just a cost savings to those market participants. Equally for the government, it would be similar, wouldn't it? I mean, the government would be receiving the stamp duty payment in a more timely basis if it allowed for an e-payment process. Electronic records should provide the government with better data and better data to monitor the compliance with their stamp duty obligations. And again, it's the cost savings to the government, from less administration involved in collecting, receiving those stamp duty payments. So overall, both the participants, market participants, but also the government itself would benefit from just bringing their sort of payment facilities up to speed with how the industry operates. It's as simple as that.
Yeah, win-win for all. It's right. Definitely something that we should adopt ASAP. So now I want to open the floor for questions. I have got quite a few from the audience. So I'll start with the first one from David Wong. So how much is the government getting in revenue from the stamp duty now? And how much will be the revenue loss if the government adopts our 5 recommendations? Maybe I'll turn to Rex first and then Darren.
Okay. In fact, Hong Kong stamp, I don't have the exact number, but roughly Hong Kong stamp on stock transaction itself, it accounts for, I may not be 100% accurate on that number, probably up to 15% of the recurring tax revenue, putting aside all this land sales, but this tax revenue, overall tax revenue is around 50%. So in fact, this is a big number. Stamp duty on stock transaction, in fact, is a very efficient tax type. In the sense of the number of resources actually need to put in by the government to collect that 50%, in fact, is not a lot. Okay, so this is a big revenue. So we also understand that, and I think this is also one of the reasons when people debate whether we can abolish stamp on Hong Kong stock. This is always one of the very key consideration factors. Then, in terms of whether our 5 recommendations will lead to the drop in the revenue. If you have to look at these 5 recommendations, stock loan, this is only an administrative fix. We don't believe that will actually create any a drop in revenue, because the government basically the legislative purpose is to allow exception for this transaction. Okay. The second one is use Hong Kong stock as collateral. Again, these should not actually lead to the drop in the revenue, given people actually are not using Hong Kong stock as collateral right now, even because of the lack of the exemption. The third one is the market intermediary. Again, I think this one, and then the last one, the payment of electronic payment should not actually cause any revenue loss. I think the only recommendation which may lead to some revenue suffer is the gift of is to provide exemption for the warrant and CBBC, the hedging of market making activities. But we also actually need to, as I mentioned about the ETF success story, by giving up some of the stamp duty you collect from these hedging activities, it may actually lead to a boost of the overall trading volume, which will actually lead to other revenues to the government. So this is something to look at. But in general, we don't anticipate these 5 recommendation will lead to material drop in the revenue to the government.
Yeah, I agree with that, Rex. And you make a really good point at the very end. These proposals may not have much of an impact on their own with respect to the loss of stamp duty revenue, but actually it may further facilitate and promote liquidity in the market, which Rex just mentioned, which should hopefully boost the market, which could benefit the government through ultimately increased stamp duty revenues going forward. Because obviously the stamp duty charge, which the stamp duty revenue, which Rex mentioned, is a fairly material component of the government's revenues, and it fluctuates each year depending on trading activity. But it's anywhere from 17 to 15% per the report that we issued. Yeah.
Thank you. I've got a question. I think this is for Pink. From Jeff Chang. How can we eliminate these barriers to entry? What are being done to make changes to improve the market trade? I guess these barriers to entry means the cost, right? Trading costs, so on.
Yeah, again, as mentioned earlier, I think the Hong Kong market is actually quite efficient. So in terms of the barrier, I wouldn't imagine there's a lot, even though using the warrants and the CBBC as example, the stamp duty rate is very high, but there's still a lot of market players are willing, the financial institutions, they're willing to enter into this market, offer this product to our clients, because overall the Hong Kong market is, is attractive, including Hong Kong plus mainland China market has always been attractive anyway. Especially post-COVID now, we see the trend of going up, right? So if the Hong Kong, really we're talking about enhancing or making the market is more efficient and more attractive to the global investors, is the barrier in terms of modernize the rules and also reduce this kind of unnecessary cost, because the warrant on stamp duty on the warrant, just to put a little bit more words on that, is indeed not a lot of countries have this kind of a stamp duty where the transaction tax imposed anymore. We see the financial institution, they know they're loss making, but they still wanted to offer this product. which is not healthy, right? Because essentially, even though people can bear this kind of cost because they're interested in this market, but gradually, if the moment they found a way out, they find there's other market, they can break into this barrier and solve this issue. Because at the end of the day, financial institution investors, they want to make money. Profit driven, that I have to say, that's an investor's end goal. So the moment they find other markets which actually offer more incentive, they will leave. They will, right away, they will change. They're very nimble, very agile in terms of, chasing for the profit. Very clear example, like, right now, we have been in the market. People find that the warrants, a lot of investors are interested in the warrants, CBDC in other Asian markets already. And those markets actually do not impose this kind of a service tax or transaction tax on those kind of products. There are firms are actually expanding to those markets. So if they can make money, the investor can make money from those markets, Southeast Asia, what have you, they're going to leave Hong Kong. The moment they have a choice, they're going to leave this product, from Hong Kong perspective. So that's why I think in terms of barrier, especially from tax standpoint, the more we can improve at the expense of not so much, too much expense from a government perspective, it actually is something, worth to consider.
Thank you so much. We still have questions from the audience, but unfortunately, our time is up. So please stay behind for a quick polling survey. On this note, I want to thank panelists again for the great sharing. Thank you.
Thank you.